Hello and welcome to Livewire's Views from the Top, our series dedicated to bringing you the best ideas and insights from those at the top of their game. I'm Ali Selby, and I don't know if you've noticed, but there's been a hell of a lot of M&A activity in infrastructure assets on the ASX over the last few years. There's really only a handful of players yet. So to figure out why these assets are so attractive and whether you should be investing in them too, we're joined by Magellan's infrastructure guru, Gerald Stack. Thank you so much for joining us today, Gerald. Really excited to feature you on the show.
Thanks, Ali.
I guess our audience doesn't know you very well. We haven't done a lot of content with you in the past. Is it possible you could share one thing with our audience that you think not many people would know?
I grew up in Western Australia, and that's important to me in a number of fronts. One, it means I'm a big AFL fan. It also means I grew up around a lot of wine. Margaret River was an area that we used to go to a fair bit as kids. And so I'm an avid wine fan and something of a wine collector. But with the pandemic, I ended up, when I got COVID, as we all ended up getting, I lost my sense of smell. So wine as a collecting is a foregone conclusion for me these days.
Oh my God, I don't know how you live anymore. You've been investing in infrastructure for 30 years. Given that experience, what's your outlook on infrastructure returns over the coming 12 months, and where do you see real rates heading?
Okay, so I'm going to answer that by referring to the longer term, and then I'll try and frame it in the short term. In the longer term, we would expect infrastructure to deliver returns for investors, total returns of inflation plus 5. So let's call inflation 2.5 through the cycle. So we're talking about a 7.5% total return. And today we'd probably expect 3.5 to 4% of that to be in yield and the rest to be in capital growth. So that's the long-term expectation. Where we move in the short term relative to that depends a little bit on where real interest rates go. In other words, the inflation adjusted interest rate. Inflation of itself means earnings from infrastructure assets increase, but the increase in inflation tends to bring with it an increase in interest rates. The two offset each other, so it's value neutral over the long term. But in the short term, or at any given point, if interest rates move up by more than inflation, if the real interest rate rises, then your value falls as a result. So depending on where you think about real interest rates, then you have a view about where share prices are likely to go over the medium term. Today, we would expect that interest rates, real and nominal, are likely to be pretty sticky where they currently are. So we're expecting that inflation plus 5 to be a realistic outcome over the short and medium term. At some point, we probably expect interest rates to dip a little bit, not a huge amount, but a little bit. And when that happens, we probably expect infrastructure investment returns to get a little bit more sugar, to do a little bit better than that. But as we move forward, a reasonable expectation over 12 months, 3 years, 5 years would be inflation plus 5, sort of 7.5%, 8%, somewhere of that range.
Okay, in a recent presentation, you talked about, I guess, the performance of oil and its relation to infrastructure returns. Can you take us through that a little bit?
Yeah, so there's a bunch of different assets, particularly in North America, which are typically oil and gas pipelines and or storage facilities that essentially toll the value of the oil going through their systems. They have different ways of doing that, but that's essentially the outcome. They toll the value of the oil. So therefore, as the oil price or the gas price, if they're tolling the gas that goes through their system, if that commodity price rises or falls, then their revenue will rise or fall with it. Now, the way that we think about infrastructure is we want earnings reliability and predictability. So we tend to screen these assets out of our potential universe. But they do sit in the benchmarks. So if you think about the broader benchmarks and the infrastructure world, if the oil price rises, it will mean the benchmark rises with it to some degree. And similarly, if the oil price falls, the benchmark will fall with it. Our funds, we extract that from it. So it means the rise in the oil price or the fall won't impact the total returns that I talked about, inflation plus 5, but it might mean that for a period we're different to the index, that we either outperform or underperform the index because we don't invest in that particular sector. I'm not saying we will outperform or underperform in those circumstances, but we face a headwind or a tailwind according to what the oil price is doing. So it's a direct influence on the revenues and therefore earnings of those pipelines and storage assets, and therefore you should expect that their share prices will adjust accordingly. So you need to think about when you're investing in infrastructure, what actually are you investing in?
Okay, how big is the investment universe when it comes to infrastructure? And then for your portfolio, what types of companies usually make it into the portfolio and which usually don't make it in?
So if you look at all the different indices out there, and there's a bunch of them, collectively there's about 350 companies that go into those different infrastructure indices.
Many.
It's not huge, but it has a market cap of about $4 trillion US, which is close on 4 times the size of the Australian Stock Exchange. So that's the potential universe. We apply a more stricter definition of what infrastructure is. We only want to be in those things with very reliable, predictable earnings. And that leads us from that 350 companies to actually a universe of 140 companies. And that's what we would regard as investment grade, high quality infrastructure. Now that universe has a market cap of about 2.4 trillion US dollars. So about twice the size of the Australian Stock Exchange. A lot smaller number of companies, but much larger average size. So it's quite a large universe of potential investment, but only a small number of companies, 140 or so.
What types of companies would typically make their way into your portfolio?
So what we're after is high quality. And so when we think about infrastructure, we think the argument for infrastructure is one of diversification. It deserves a place in people's portfolios because under certain circumstances, it's going to perform really strongly relative to other asset classes. And those conditions are typically when economies are performing poorly. Because if you think about infrastructure assets, they supply a service that communities rely upon. They are essential services. These are things like water, energy, transport, and the demand for these services is very reliable over time. So what we want to do is we want to focus on that group of companies, but we also want to screen out at the same time anything that faces some sort of external variable that's outside the company's control that might mean that their earnings are actually not reliable. So hence, we avoid anything with commodity price risk, the oil price risk. We want to avoid anything with competition. Competition's a wonderful thing for consumers and a pretty terrible thing for infrastructure investors. It means pressure on margins over time and therefore earnings not reliable. So we don't want competition, we don't want commodity price influences, and the final thing we don't want is sovereign risk. The nature of infrastructure is that if you're the asset owner, you build this big, typically ugly piece of capital equipment, a power station, airport, toll road, and it costs you a lot of money to do that, a lot of capital expenditure day one, and then you rely upon a long series of cash flows into the future. If having built that asset, the government decides it wants to take some of that sugar from you, some of the earnings, that's not a great thing. You've spent all the money, you're entitled to your return. So it's really important to us that we are able to trust in the rule of law in the jurisdictions in which we invest, and therefore there are some jurisdictions which have often extremely attractive themes as they pertain to infrastructure, but we can't trust the rule of law. We can't protect our property rights. And they're jurisdictions like China and Russia and the like. In those jurisdictions, governments are operating around different parameters to what we might be used to in a country like Australia, and often for good public policy reasons, but not great for shareholders in some of these companies, so we avoid those jurisdictions. So what we're trying to end up with is a group of very high quality companies, very resilient earning streams, resilient in the long term. There are structural reasons to believe that you're going to have very reliable earnings over the long term, that are interest rate agnostic and inflation agnostic. And I mean structural over the long term because when we think about airports, well, in March, April of 2020, the number of people flying in airports around the world fell 98.5%. So, in the short term, that meant earnings were highly unreliable. They were going to zero, or indeed below zero in many cases. But over in the ensuing period to December last year, December 2023, we've seen those passenger numbers essentially get back to where they were in December 2019 to pre-pandemic levels, and earnings come rushing back as well because there's a structural demand for travel. So that's what we're after. Earnings that, if we look out with a 5 to 10 year lens, we can be really confident about where those earnings are going to drop. And that gives us confidence about value over time. So that's what we're after. We're after these companies with high quality, highly reliable, highly predictable earnings. That underwrite the valuation of these things. It means you're not going to get rich quick here. This is absolutely not get rich quick territory, but we can be very confident we'll grow investors' wealth if we stick to that definition over the longer term. In the short term, things will happen, pandemics, interest rates will move, but over the long run, we can be very confident that the nature of the earnings from these companies is going to keep spitting out because the demand is so reliable, they've got structural forces in their favour, and we can be investing in those companies with a high degree of confidence, and that's what they offer an investor over time.
That sounds pretty attractive. Do you think there's any risks that investors should be aware of?
I think there's always two big risks with infrastructure. There's always smaller risks in any given situation, but there's two big risks that apply to all infrastructure. Infrastructure is essential services and generally in a monopoly setting. So as a result of that, it's regulated. And because they are essential services in that monopoly setting, you should expect to face social licence risk. That is, the community, as through the government and the regulator, will be constantly looking at you to make sure you're not abusing the franchise you have as that monopoly owner of an essential service. So that's always a risk. And the second risk is real interest rates. Real interest rates, if they rise, that's an increase in the price of future cash flows. The value of any asset in the world is a function of how much cash it's going to give you in the future and the risks associated with those cash flows. So if the real interest rate is rising, then the price, the risk associated with those cash flows is rising and the value is falling. So real interest rates is an issue for all infrastructure assets, and social licence is the other one.
Okay, as I mentioned in the intro, there's only a handful left of ASX listed infrastructure stocks. Do you see that M&A activity continuing? And if so, will there be any infrastructure stocks left on the ASX?
Yeah, well, if I go back to when I started at Magellan 17 years ago, it was a much more vibrant and stronger, more depth to the Australian infrastructure industry. And periodically they've been picked off by the unlisted players. So today, yeah, as you say, only a handful of companies. But this has been very much an Australian thematic. If I go back to that time, where the universe that we faced was about 150 companies, and today it's about 140. So there have been reductions, mostly in Australia, frankly, around the world. But there have also been additions that have come back into the market. What we would expect to see over time is that the nature of these companies, if they have a short-term issue that gets capitalised into the share price. So for example, if you have, like Sydney Airport, if you have a situation where there's a pandemic and the people aren't flying, that means your returns go down for a period. But if you can look through that over the longer term, you can be very confident about where value is going to be in the longer term. So the share price often overreacts, both up and down, to positive demand shocks and negative demand shocks. And so what you find is that the share prices don't just fall by maybe 5 or 10%, but fall by 20, 30, 40%. In that situation, educated, knowledgeable infrastructure investors are likely to come in and acquire those assets. And we've seen that over time. We saw that with Intoll here in Australia. We saw that with Connect East. We saw that with Spark Infrastructure, with Duet. We saw that with AusNet, we've seen that with Sydney Airport, with Hastings. So this has happened to a number of different assets with a very similar story over time. Will it keep happening in Australia? Look, it might. Yeah, that would be the cocktail where we would see it. But we, as global infrastructure investors, what we do expect is that we'll continue to see more assets come to market over time. And we've certainly seen that over the last 10 or 20 years. We've seen privatisations out of governments, we've seen spin-offs out of existing corporates, and we've seen new assets be built, greenfields assets come to market. So we think the outlook for listed infrastructure is actually pretty optimistic. And to the extent that we see these takeovers, then that's just part of the lexicon as we move it through.
Okay, is it possible you could provide 2 examples of high conviction holdings within the portfolio right now?
Sure. So I'm going to talk about a toll road, I'm going to talk about Transurban, a toll road company, and I'm going to talk about AENA. Now, toll roads really come in 2 forms. Urban roads that exist in a single urban centre, or interurban roads which connect multiple towns and cities. Transurban is an urban toll road company. They own roads in Brisbane, Melbourne and Sydney, as well as in Canada and the US. And the nature, we really like urban traffic. We regard urban toll roads as essentially the kings of infrastructure assets, and the reason being that no one really likes toll roads. I get that in the public. Investors like them, and they like them because you build a toll road because the free roads are full and the government doesn't want to pay for the new ones. So therefore, if you're building a new urban toll road in an urban area where population is growing, then you can expect to get the lion's share of any traffic growth going forwards, because you're building the toll road because the free roads are full. So you've got a long period into the future over which you can be confident you're going to get traffic growth. And we know from experience that when you put up tolls, there may be a very short-term impact to traffic, but it is very short-term. The history of all toll roads that we've seen is that these are highly price inelastic services that, Transurban, when they put up the tolls on their roads in line with their concession deed, and other companies as well, you can expect that it will have a very limited impact on traffic over the longer term. So you've got a high degree of confidence about earnings over time. In the case of Transurban, they own somewhere between 15 and 20 different assets, and they collectively, that gives you a level of diversification in terms of the individual asset contribution. But you're exposed to that broad thematic of growing traffic in urban areas. And if you think about Australia, we've got population growth predicted at somewhere between 1 and 1.5%, depending on which city you look at. So continued traffic growth for long periods of time means continued traffic growth onto these roads, combined with inflation indexation on tolls, if not more, gives an attractive proposition. Now, in any single year, we're not expecting significant earnings growth, but we are expecting consistent earnings growth over long periods, over decades, and to compound on itself over time. And if you look back over the last 20 or 30 years, that's exactly what we've seen with Transurban. Consistent growth in distributions per unit at a slow rate, but compounding over time. And that's exactly why we like Transurban. So that's a big favourite of ours. The other company I want to talk about is Aena, which is the Spanish airport system. Coming into the pandemic, we had a view that coming out the other side, that leisure traffic would grow more quickly, will return more to pre-COVID levels more quickly than business. If you think about the style of passenger, you've got leisure, you've got visiting friends and relatives, which is sort of a version of leisure, if you like, and you've got business. Globally, business is about 25% of passengers. We expected that to come back more slowly. And indeed, that has been the case. It's been leisure and VFR that have grown much more quickly. Now, we've liked Aena because it's Spanish airports. This is a leisure destination. Business travel accounts for probably something like 10% of their total passenger mix. So it's dominated by leisure travel. A lot of low-cost carriers servicing that market. So this is, we've seen coming out of the pandemic that the traffic numbers have come back very quickly, and we think the outlook continues to be positive for this. We're back to 2019 type levels in terms of the underlying passengers, a little bit above that in the case of Aena, and we think there are strong reasons to believe that those traffic levels are going to continue to grow as we move forward. So we very much like Transurban, we very much like Aena. They're two big positions in our portfolio.
Okay, Gerald, last question for today. We ask all our guests something they've learnt recently or something they've realised after their decades in markets. Gerald, what's your unique view from the top?
The way that I think about investment is best encapsulated in the common quote, or the well-known quote: slowly is the fastest way to get to where you want to be. The nature of investment is you need to be planned and to be patient, and to invest to essentially seek to get rich slowly. To me, that is what investment is about. People complain about investment and the stock market being a casino. By and large, they're people who are trying to double their money in a hurry. The way to build your wealth as an investor is to get there slowly. And so to me, that's been it's taken me a long time to understand that. It's been a common theme, in particular in the infrastructure world, but it's something I truly believe in. Planned properly, executed well, with patience, you can be very confident of growing your wealth over time as an investor. So there you go. Slowly is the fastest way to get to where you want to be.
Slow and steady wins the race.
Exactly.
Well, thank you so much, Gerald, for your time today. It was a pleasure, as always, to feature you in Livewire's content.
Thanks, Sally.
If you enjoyed that too, don't forget to subscribe to Livewire's YouTube channel. We're adding so much great content just like this every single week.